Markets rallied sharply for the second straight day. Tesla reported yesterday after the close. The numbers fell short of estimates, but the stock is higher. We'll discuss the three primary reasons why and take your questions today with Brian Stutland on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mike. Two big things propelling stocks over the past 36 hours. Yesterday, President Trump insisted he has no plans to try and remove Fed Chair Jerome Powell. And today, the administration appears to be reevaluating tariffs after meeting with some CEOs. Both Trump and Treasury Secretary Bessent acknowledged tariffs with China need to drop, although Bessent did say they need reciprocal action from China, which happens to see American households and the pain they're feeling as a way to maximize leverage in these negotiations. So before we get to Tesla and Brian Stutland, I just wanted to bring up some unusual activity that we saw today. Intuitive Surgical traded about 3 times their average daily volume. The stock was up a little over 2%, along with its peers. It's still down about 6% year to date. The company reported earnings and saw a gross profit margin increase from 65 to 66.5% and sees worldwide procedure growth of about 15 to 17%. You can see the flows along with the stock chart here as I'm displaying it on Unusual Whales. And if you haven't seen this screen before, I just want to point it out. So the green is going to be the net premium on the call side. The red line over here is going to represent the net premium on the put side. And here we can actually take a look at where that showed up over the course of time. So I think that's kind of interesting. And over here on the right side, I realize this is very small, but you can, from this, actually see, maybe I can actually expand this window. We'll see if I do that. I don't know if that's going to help or not. But you can see the top chains by volume over here on the upper right-hand corner. And by the way, I'm kind of hustling through things today because both Brian and I have a hard out today. So GE Vernova, they reported profits of 67 cents a share. That was higher than street estimates of 52 cents a share and revenues of just over 8 billion. That beat the estimates by about 500 million. So I'm going to put that one up as well so we can see what's going on there. And that should update. And you can get a look. And this way, I'll leave this up on the screen for just a little bit in each case so that if you guys want to refer to it afterwards, you can pause the video or slow it down or whatever. Also, busy, seeing well above average activity was Vertiv Holdings. So that is ticker VRT for those who are not familiar. Vertiv Holdings earnings beat estimates by a modest amount. It was only about a 4.4% beat. I think they reported 64 cents in EPS, and the street was looking for about 61 cents. Sales of about 2.04 billion were about, they were mildly better than the 1.94 billion or so that the street was estimating. Now, also interesting, American Express. Now, American Express did not just report. They reported actually last week. But this one has continued to see some above average activity. They got upgraded today at Redburn Atlantic, and the bulls in American Express continue to cite the fact that American Express customers tend to be in a more resilient demographic than some of the other issuers. Another name, now this one has been showing a lot of activity lately, and I figured I would mention this one, and maybe Brian has a view, and we're going to get to him in just a second. 3M. So 3M didn't do particularly well today, but it is up 6%, I think, year to date at this point. I have to actually go back and take a look at that, but it was seeing substantial volume. This is not the first time that we've been seeing this. It's been having quite consistently above average activity now for a couple of days. The full year forecasts appear to be in line with the street estimates, and perhaps some folks are taking a look at that and thinking that maybe the company would have experienced something a little bit worse. Q1 net sales of about $6 billion, adjusted EPS from continuing operations of $1.88 a share. That beats the $1.70 estimate. The company is still way below the pre-pandemic highs. Free cash flow yield numbers right now, depending on whether you're looking at the market capitalization or the enterprise value, which are about $70 billion and $80 billion respectively, It's, getting about 3.75% free cash flow yield on an enterprise value basis, over 4 on a market capitalization basis. And it's trading about 17.7 times full year estimated earnings. And I think that's fairly reasonable. Josh Brown of Ritholtz, I think, had this one as his final trade on yesterday's halftime report. And then, of course, Tesla. So those who were watching the show on Monday know that I did not expect to see great earnings numbers coming out, and indeed they weren't. But the stock was up yesterday, basically along with the market, but then it went up a good deal after hours. So what was going on there? A couple of things. First of all, Elon was assuring investors that he's going to be less involved in DC and is going to be refocusing on the business. I think he mentioned that he would be spending something like 2 days a week working on some of the stuff that is based in DC. This is a guy who works 7 days a week, so that still leaves 5 full business days, arguably, for him to focus on Tesla. I think that obviously was an important part. Another important part of the reason for, I think, the strength was the operational success. The company rolled out the Model Y at apparently 4 different factories successfully and concurrently. I've actually seen a couple of those things driving around. Sort of represents the strength of the company's operations and management. And arguably one of the things that is more important here was that, among other things, they were talking about full self-driving, monetization, and stuff like that. And he hinted that mid-2026. Now, his assurance is, by the way, when these things start to happen, usually you can push back those estimates a little bit, but mid-2026 is when he started to indicate that you could see some potential benefits, financial benefits to the company. I spoke to Eric Schiffer, who runs Reputation Management Consultants, yesterday, and he pointed out that he thinks that, the sort of the polarizing knock that has happened to the company's shares as a result of his involvement in DC is a correctable thing, and that his vision, his innovation, and his ability to communicate that are his superpower, and that Elon being Elon, that he's going to find a way out of this. So, Brian, good to see you. Thanks for joining us today. And I know, like me, you have a hard out. So I just mentioned we're going to be keeping this pretty quick because I've got fast money. I know you have a hard out as well. So before we get to some questions, because some people had some specifically for you, as it happens,
Okay.
I thought I would just get your opinion. What do you think of the tariff stuff? The fact that Trump sort of backpedaled a little bit from his criticism of Jerome Powell, and Tesla. What are you thinking?
Well, first I'd like Jerome Powell and Trump, but it feels like Trump uses the stock market as a test for his policies. He just throws something out there, sees if the market likes it and can digest it, and if it doesn't like it, he starts, reeling back from those comments or whatever, which is making for tremendous amounts of volatility in the stock market. Probably unnecessary volatility, but it is what it is. Hey, we're trading it. That's why you learn about option trading, because option trading, as our old producer liked to say, risk less to make more. Max Myers, that was his famous saying, right?
Yeah.
So yeah, look, I mean, he retraced a little bit from Powell. Obviously, there was a lot of negativity around that. What is very interesting is that the market actually, if you look at a recent low to high move, following everything that's occurred with the tariff side of it, basically the blow up, to the upside, the market retraced 61.1% Fibonacci retracement, almost to the penny, on his comments about Powell. Then all of a sudden it bounced off of there. He retracted that statement, and the market's been back in rally mode. So it was almost like, he threw that out there to give people a chance to actually get back into this market that maybe got run over by the tariff change. So it's just a ton of volatility out there. It's so tough to navigate.
Yeah, on the volatility front, I was taking a look at the VIX futures curve on or about the close. It was slightly before the close when I was looking at it. And indeed, it has pulled back from where it was a week ago, but it's still a heck of a lot closer to where it was a week ago than it was to January 21st, the day after the inauguration. So it seems like, people are saying, well, maybe it won't be quite as bad. Conciliatory remarks are helpful. But, I mean, can you put this volatility into some context? I mean, I was taking a look at the July futures, for example. I think going back 35 years, and this is an average of all time, good and bad. So tech wreck, Russian default, you name it, every bad thing in there, that, the 30-day volatility for the S&P is probably in the neighborhood of 19, inclusive of all that bad stuff. The VIX futures are still well above that right now, aren't they?
Oh, yeah, they are. I mean, the VIX itself is above historical means right now. The level of volatility in the market is above historical means. When you look at the day-to-day back and forth movement of the market, it's if you're a trader, it's a great kind of market atmosphere. If you like, having the stomach, as long as you sort of price things out accordingly, don't take on too much risk. There is getting some chance to back and forth to get in and out. But look, I mean, when you look at the VIX futures, March historically has been one of the more volatile months where we see historically the VIX rise. And then obviously that was delayed a little bit into April because everybody was waiting for that April 2nd tariff, as you and I were both here together on this show as they announced the ridiculousness of it all. And so, people were kind of waiting for that. So that volatility kind of got pushed back a little bit into April. Typically now we're going to head into the summer months where volatility backs off. And the VIX futures curve, speaking of that, those VIX futures are still trading at a significant discount to the VIX cash index itself. So VIX futures traders at least predicting that some of the volatility will subside in terms of implied volatility backing off into some of these summer months. But remember that 90-day window of, hey, let's reanalyze the tariff thing comes up in July, right, Mike? So I would probably be a buyer of volatility in the later months, third quarter of this year.
Maybe you can give viewers a little bit more color on the difference between the VIX futures and the cash. So just as a reminder to folks, the VIX is priced off of SPX options prices. So why don't you just elaborate a little bit what you're talking about when you are looking at the distinction between cash and the futures?
Sure, that's a great question for people that are trying to learn what the VIX is, as it can be a little bit confusing. The VIX itself, the index, is measuring 30-day option premium on the S&P 500. It's looking at out-of-the-money options on both the calls and puts, making a calculation off those premiums and giving you sort of a relative value of what option premium is worth in the S&P going out 30 days to expiration approximately. Now, the VIX futures is a cash-settled product, meaning it settles into the value of VIX on one given day. That's the Wednesday opening price. It's the expiration of it itself is going off the next month S&P option, so it's 30 days prior to that. But let's say, for example, the May VIX futures, that VIX future contract is looking at June Friday expiration S&P 500 option contracts, and as those price out, the May VIX future is moving around. Now, it only has to cash settle, and meet on that one given day. Prior to that, it can trade independent of supply and demand, meaning that if there's more buyers than sellers, they can push the VIX May future up above the value of the VIX. It just has to settle at the VIX on the day of. So there is some level of disconnect that occurs between the two. So when I talk about VIX futures are trading at a discount, it means VIX futures traders are predicting that the VIX itself will cash settle back down lower to those VIX futures contracts. So as a trader, you don't necessarily see the day-to-day movement one-to-one with VIX itself, with the VIX futures contract, because it's a mean reversion product, and so people put premium discounts to that. But note that the VIX futures don't have to meet the VIX until that one settlement date. It does have to settle in. So right now, May futures are actually providing a little bit of a discount if you were a buyer of them, and nothing were to happen, the VIX were to stay unchanged from now until May expiration, the VIX future May contract would actually rise about 9 or 10% into that VIX settlement price from this level.
How are those futures looking relative to the term structure on S&P options for the relevant period right now?
Right. So each of those term structures of, let's say, May is looking at June. The June VIX future is looking at July S&P options, right? So as you continue to go out, you actually get a sense of what that term structure looks like in the S&P. So let's say you don't even want to trade VIX futures, it's going to give you an indication of where they think volatility is going to be in those months, right? So right now we are seeing July at a more discount and June as well as a more of a discount, lower price than what the May VIX futures is. So you can expect S&P options implied volatility going out to June or July at a discount, which I mentioned July being, sort of the next 90-day window D-Day, something to look at.
Yeah. I may bring up some term structure charts here just really quickly. I'm just going to pull up SPY because I think that's a decent sort of proxy for the S&P 500. This goes out fairly far in time, but if you're just taking a look at this, one of the other places that you're going to see this, other than being able to look at the VIX futures curve, is you can take a look at either the CME S&P 500 term structure or the SPX index options term structure or the SPY options term structure. And that's the one that I have pulled up here in the upper right-hand corner. And you can see that this is typically the case. When the market has these kinds of disruptions, the vol in the near term tends to be much sharper. And when you have these sort of volatility shocks, you will tend to see the front end of the curve trade, if we were thinking about this in futures term, in backwardation. That is to say that the near-term implied volatilities are higher. The normal structure for most equity index products is that it's in contango, meaning that the front-end volatility will generally be lower than the longer-term volatility. Right now, you can see this is a downward sloping term structure. Okay, so I mentioned that we had some questions for you, and I think these questions were actually asked in anticipation of your arrival in the prior couple of days, but I just thought I would bring them up here. So Eileen says, great show. Question for Brian. Brian had mentioned a possible downturn in UNH, in United Health. Was the reasoning Medicare costs? I thought that would be a good hedge against the downturn, but now its downturn has been awful. Yeah. So I'm trying to remember, but I guess you obviously had brought up UNH. I should probably bring this up over here on a separate screen so we can have it handy. We have I'll put the volatility up first, and then we'll go to a charting. What do you think?
Yeah, I mean, UNH is one of those things we actually dumped from our handful of stock of portfolios that we picked both for our for all of our clients. And yeah, it's a staple in sort of like the Dow and obviously the S&P, but really we've had this concern that in some ways Trump, yes, he's a Republican, but he has a lot of Democratic values behind some of his policies. One of those being trying to figure out this healthcare, mitigate some of the costs of healthcare, and then you couple that with the fact that there's sort of been this backlash from the occurrences that happened, unfortunately, with their former CEO. And you see that people are a little upset with the stock, and probably, just from maybe group health plans itself, having that thought in mind, we've obviously saw their earnings come out and not been too good, right? The stock took a big hit. So we've really tried to stay away from that stock. I think there's just too much negative backlash right now around the insurance business. Everybody's feeling the pain of higher insurance costs. So I don't care what the CPI numbers say. Insurance is rising a lot faster than that. It's college, universities, insurance, which probably hits home both to you and I coming up here with our kids going to school at some point at university levels. But both college costs and health insurance costs just continue to rise astronomically. And I think a lot of negative backlash, negativity about the stock. Sometimes it doesn't have to be an earnings PE thing. It could just be sentiment on one sector or industry that takes place. And UNH is one that I would probably continue to stay away from.
Yeah, it's interesting that you mentioned that because, yes, I mean, you run your own business, so, you and I both are quite familiar with the costs of health insurance because we write the checks. So yeah. you get a good sense of what it is. You have a couple teenagers or kids going to college, you get a sense of what these things are. And the costs are indeed astronomical. I think one of the other things that hit United Health, just to bring this full circle, was that a common metric when you take a look at an insurance company and its valuation is the payout ratio. That's how much of the incoming premiums the company is going to be paying out in benefits. And actually, when they reported earnings most recently, those numbers came out a little worse than expected. So it's a combination of things. This is a company that for many years I really did like. It was just a consistent grower, seemed to be very effectively managed. But I agree, it's kind of a difficult environment for them, and there may be better places. I do think that the company has gotten to a valuation where it might start to look pretty interesting. I mean, we're I think in the mid-teens right now in terms of earnings, but the earnings numbers we should probably expect those to come in a little lighter than prior estimates looking forward. I have a feeling that a lot of the damage has already been done for the reasons we just cited. But those are some of the reasons why we've seen that. Okay, so we have another question.
By the way, one last comment. I would just say that, because your point is the valuations are looking for. I would agree. Like the downside is probably not as great as potentially reversing to the upside. I just think, it's hard to catch a falling knife when there's so much negative sentiment about it. And I do think the company, to those earnings plays are trying to clean up their act a little bit, pay out benefits maybe a little bit more. They've been taking advantage of the marketplace for so long right now that that's going to be, a temporary hit. And maybe another quarter or two, the stock becomes very attractive at that point after they've kind of sort of, cleaned up how they're going to sort of operate their company.
Yeah, I think for people who own the stock, just to follow up on that, depending on it's not likely that too many people who are heavily invested in equities are looking for offsets in the form of realizing losses in the event that you happen to buy the stock relatively recently. And that can sometimes be a reason why you would take, basically sell at a loss so that you can offset some gains elsewhere. You might want to do that. I do think that in the long run, they're going to sort this one out. But it obviously is a little bit heavy right about now. But, that's true probably for a lot of things in the market. So another question for you. This one... So, options question for Brian. JP Morgan's JHEQX, their hedged equity fund. This is obviously a very well-known fund. It's a whale in the market, as we would say. Uses quarterly expiration put spread collars. It has to unwind and reset collars quarterly. Do they manage options through the quarter? So that unwind part, I'm not 100% sure. I mean, SPX options are cash settled, so we'll get to that. But do they manage options through the quarter? One can look at where SPX closed quarter end and large open interest at the beginning and near the end of the quarter. How to profit from JP Morgan if they have to do this quarterly? I'm kind of paraphrasing that a little bit, but what are your thoughts there?
Well, we definitely watch that, honestly, because we're trading S&P options and we're hedging. So it is very notable to be paying attention to what they are doing at the end of the quarter. This person is actually pretty intelligent. So when you look at the open interest, you can actually see exactly what strikes they most likely have on in terms of this put spread collar. And yes, at the end of the quarter, you're right. It's not like an exact unwind necessarily as it is put back, put the new trade on, so to speak, right? And so what this does is because they're basically buying one option and then selling wings, what I believe kind of happens is market makers try and get ahead of that a little bit in order to take down that trade, in order to generate enough edge for them to take down the opposite side of the trade. Somebody is taking it down, whether that's in independent market making firms or a bank taking the other side of it, or JP Morgan's trading desk taking the other side of it, whatever it is. So this is something to watch. It's a little tricky to profit from, other than what I like to do is typically the put that they're buying on the put spread is about 5% to the downside. They sell a 20% out of the money put. Okay. So now what they do is you take the premium cost of that put spread and you can figure out what call strike they're going to sell based on, they try and make it a zero cost. So they sell the upside call premium at the value of what that puts, that 5% out of the money, 20% out of the money put spread is. So you can kind of get ahead a little bit and anticipate what those strikes are. What I typically find is on the end of the quarter, the new trade goes up in the morning and it's just done. Like, you're like, what happened? It traded. It's over with. So it's tricky to kind of get ahead of it. I guess if you were really trying to play it, is maybe you could sell that, try and figure out what that out of the money call is, maybe sell a strike up there, see if implied volatility, try and hedge that delta neutral with the gamma and delta play on it, and wait for vol to come down and then try and be a buyer of it. But that's a little bit of a tricky trade. But you can look at this. I look at it more that the open interest on these strikes is so enormous that as you get closer to the end of the quarter, that long strike, actually, all those market makers are short that strike. So that actually acts as sort of a repellent from that strike, whereas the short strikes tend to act as like that they're short, a magnet, right? So that's something to watch. You could kind of trade around those strikes if we get close to the strike. So I like watching the open interest there and trying to figure out, is this market going to bounce off those levels, or is it going to get stuck at that level?
Yeah, so let me just elaborate on this a little bit. This was a common dynamic, and actually this matters, in anything that has substantial open interest. If you know, so in this case, because you know the structure of the initiating trade, if you're trading a put spread collar, what does that mean? It means you're selling an upside call, you're using the proceeds to finance the purchase of a downside put spread. So you're buying a higher strike put, and you're selling a lower strike one. So you know what the structure of the trade is. Therefore, you know what the structure of the dealer's positions are. They're going to have the opposite side on. So the dealers own the wings. They are long the lower strike of the two puts, and they are long the upper strike call, and they're short the other one. The way options market makers function, they typically hedge their delta. What does that mean? That means that if you are long gamma, that means that your delta increases as the underlying price rises, so you're selling the underlying. And as it falls, you're buying it. So what this means is that the closest strike in this structure, when it's first initiated, is going to be their short put strike. The dealers are short gamma at that point, which means they actually are buying on the way up, but they don't have to buy too much because they actually know the risk is somewhat capped. But the point is that when a dealer is short gamma, they have to buy as it goes up and they have to sell as it goes down, and that can increase the volatility. That's why Brian was talking about the strike serving as a repellent. As it runs through the strike, they have to buy the underlying, and they can actually push it even further away. But as it gets closer to the strikes that they're long, the exact opposite starts to happen, and they can start to sell it. And when you see a lot of open interest in an underlying at expiration, if the dealers are along the strike, the underlying can gravitate right to it. And we call that effect pinning. So it can pin to a strike at expiration because the dealers are buying it below and they're selling it above. And they will do that right up until the last possible minute. So in single stocks where maybe there's not a lot of liquidity, and I'm sure Brian experienced this when he was a market maker, I certainly dealt with it. You're sitting there until the last possible minute when you can decide whether you're going to exercise your options or not. And you're buying or selling as it works like that. So, that's very helpful and interesting. Let me see here. So, good morning, Mike and Brian. I said I wasn't going to trade Tesla earnings, but I couldn't resist the great premiums. Turned out well. I don't know if we have this up. So, I actually didn't expect the stock to do that well out of the numbers. I guess you should never bet against Elon, although you could have bet against Elon, I suppose, right around the time of the inauguration when Tesla was very close to its all-time highs. But I happen to be looking. Let me see if I can pull this up. I had somewhere. So I discussed two possible trades going into Tesla earnings. One of those was what I actually was interested in trading myself, which was not such a great trade, which was a calendar put spread, May 30th, September 185 put spread, because I actually thought the stock could potentially drift a little bit lower, felt heavier to me. Of course, the stock went higher. The other strategy I promoted for those who had a more bullish perspective was a strangle swap. So short the May 185, I think it was the 270 calls, and then long in September. That was around $2,700, $27 a share if you'd put that on beginning of the week, and that trade actually was around $31.50 or so by the close. So had you done that, what are you thinking is the best? Oh, one of the things I thought this would be interesting for you, the vol crush in Tesla. I noticed I was looking at the history of this. It was not as pronounced. I actually mentioned this on the Monday live stream. The vol crush is not as pronounced as it is in some other high volatility stocks coming out of earnings. What do you think's going on there? Sometimes you'll see like a 50, 60 vol drop to 28 or something. Here I was seeing, declines, but kind of modest. What are your thoughts?
Yeah, I think Tesla's kind of an interesting one because, well, it's been so dependent on some of the market conditions with tariffs and whatnot that I would say this maybe quarter's maybe behaving a little bit more unusual than normal in terms of option implied volatility and where the stock is moving and where it wants to go. So it's been a little bit goofy. Normally, I like that kind of trade structure you put on. But again, there's some dynamics I think that it's kind of creating like this binary trade kind of thing for Tesla, right? And in those situations where there's sort of binary events where it's either going to be very bad or very good, not necessarily dependent on the earnings. Obviously, that in itself is a binary event, but I think just in general market conditions right now are driving this stock. That I like using like very narrow call spreads, which have very little gamma or theta, and it's a directional play, and it either moves through that strike or it doesn't. And if it doesn't,
so you create a binary options of sorts.
Correct. Yes.
Yeah. Mm-hmm.
For those that don't know what binary options are, it's like almost like a gambling payoff, right? Where it's, let's say, a 25% chance of success. So you risk 25 to make 75 because it goes to 100. You can take call spreads and put spreads that are at very narrow strikes and create that same sort of binary payout. And those are the types of plays I make when we're in this binary situation, such as we are with a stock like Tesla.
Mm-hmm. Well, that's a good idea. I like that. Yeah, and I don't like that calendar put spread I put on because, of course, the stock did not gravitate towards the strike. When we're short strikes, we like it to run to the strike. If we're long strikes, we want it to run through them. I was short the strike, and it moved away. Not the desired outcome. Okay, we're going to just take one quick question. I'll leave this one for you. Michael Anthony, who watches the show from time to time and seems to like to talk about Pfizer quite a lot. Because I'm pretty sure he brought this up on more than one occasion in the past, and I'm going to have to jump for fast money. But Pfizer sold shares in a drug company in the UK. Pfizer has $3.24 more cash. Why isn't that going up with all of the cash? Pfizer has new drugs getting approval and has a PE of 15. His feeling is the stock should be going up. It's not. What are your thoughts on Pfizer?
Yeah, I think Pfizer kind of falls in the same sort of category to some degree as like a United Healthcare. It is obviously United Healthcare is health benefits, right? But that same overcharging the customer, right? When it comes to healthcare, overcharging, whether it's insurance, whether it's pharmaceuticals, it's kind of been in that sort of realm. Now, in terms of like the big pharmaceuticals, I like a Johnson & Johnson or Merck because I think they kind of have more of that just wide variety of drug capacity. Portfolio to sort of kind of withstand some of these temporary shocks, more so than a Pfizer feels like more dead money Pfizer than anything else versus some of these other names that kind of have some economic GDP tailwind behind their earnings.
I wanted to just bring up one stock because I thought it's not Pfizer, but it has something in common. Moderna was the other big COVID-19 vaccine-related player along with Pfizer. So those were basically the top two. Moderna has now bumped into its IPO price. This thing has completely round-tripped it. And I think, there was that huge benefit that these companies got. I actually think that even though they've been insulated from liability claims related to any harm that may have come from vaccines, I think these things are weighing on the stock. I think it's a reputational issue that people think that the benefits were overstated. Some are arguing that the harm was understated, and I think that that's a reputational issue that might be weighing on it. I agree the company looks cheap if you're just looking at trailing numbers. Some of the future is still yet to be unproven, but that's where we are. I would love very much to spend a lot more time taking your questions today, and we 100% would, but unfortunately, Brian has a hard out, and so do I because I have to jump off right now and head over to CNBC for Fast Money. I apologize for the abbreviated show, but I thank you all for tuning in. Like, subscribe, notification bell if you're interested in unusual whales. I think we have an affiliate link in there for you. And we look forward to talking to you guys next week, and hopefully Brian can join us for either Monday or Wednesday if his time permits. Thanks for watching. See you later, Brian.
Thank you. Thanks for having me on.